Good morning, everybody, and welcome to Beat the Bell presented by Kane Capital. Excited to get this morning's episode underway. So yesterday was CPI. Funny enough, the market did practically nothing by the end of the day, but there's some good trading to be had, some good trades to be taken. To talk about how we're trading today and the rest of the week and what we can expect in the markets, we've got a panel with us this morning, starting with Money Mander. Money Mander, good morning.
Whoa, I'm gonna have to fix that. Good morning. Happy hump day. I'm excited for the rest of the week here. I think we got some more volatility inducing events coming up with retail sales that just dropped. So we'll cover that.
All right, Diamond Trades, good morning to you.
What's going on, guys? As Amanda talked about, we have a lot to cover. CPI yesterday, retail sales today, PPI tomorrow. So let's dive into it.
Ramsey Rippers, how you doing?
What's up, brother? I'm doing well. I think Diamond and Mander said it well. Retail sales, some housing data, PPI. I think it's going to add some much needed color into the market. So excited to get after it.
And Mo Mamba, good morning.
Good morning, Hondo. Good morning, boys. I'm excited to hear what Diamond and Amanda have to say today about the data. Let's get it.
All right, let's get right into it with Fed forecast, economic calendar. What do we got going on, guys?
So we're going to spend a lot of time covering CPI, obviously. That came out yesterday, but before that, some housekeeping. We had retail sales come in about 7 minutes ago, 3% versus 1.8 to 1.2% expected. So the retail sales actually came in hotter than anticipated. And then the New York Empire State Manufacturing Index came in at 5.8%. Or 5.8 on the reading versus, I guess, minus 18 to minus 19 expected. The reason that one's a little bit important is because we got a negative 32.9 reading back in January, which was a bit concerning to see manufacturing activity drop off so starkly. But that 5.8 reading in February is a bit welcome. So that covers that. We really have nothing else for the rest of the day. NAHB Housing Market Index at 10. Nothing really market moving. PPI tomorrow, as we talked about, initial jobs claims as well. So tomorrow should be a pretty good day. Let's go ahead and dive right into the CPI, which came out yesterday. So looking at the CPI readings that we got, that headline number was 6.4 versus 6.2 expected. And Ryan, if you want to throw up that chart, the expectations. Actually, the first one that you had put up there would work. There you go. So we had headline coming at 6.4 versus 6.2 expected. Came down slightly from that 6.5 in December, but still beat expectations. Headline came in at 0.5 plus 0.5% month over month, which, while it was expected to come in that hot on a month over month basis, is still slightly concerning. We're going to dive a little bit more into that. And then core came in at 5.6 versus 5.5 expected, pretty much in line with expectations there. So let's go ahead and dive under the hood of these inflation numbers. This is the seventh straight month that we've seen a year-over-year decline from that 9.1% peak back in June. Ryan, if you want to throw up the there you go. That's the perfect chart. So this chart here breaks down CPI and price pressures really by all of their sort of different components. And you can see that the gray shaded regions are going to be your month over month change. And those deep purple regions are going to be your year over year change. And so looking at the month over month changes, or at least the last 3 month changes, rather, the gray is the last 3 month change on average. So if you're looking at your little gray bars, right, you see that we actually have increased month over month, or at least on a 3 month rolling basis, in more or less every single sector. Like, there is a lot of year over year declines, which is exactly what Powell was talking about with this disinflation, right? You see gasoline on a sharp year over year decline, airline fares, used cars and trucks. So there are parts of the economy where we're definitely seeing some disinflation rather. And Powell noted that, right, in his speech at the FOMC meeting and his speech at the Washington Economic Club. He was really harping on that disinflation. But he was also talking about how this battle against inflation would take a little bit longer than anticipated. And we've seen some of those upward price pressures in several, really most of the sectors of the economy over the past 3 months. So shelter is up on a year-over-year basis, 7.9% year-over-year, which is the most since 1982. Though housing prices are expected to ease in the second half of 2023, that is still, again, the highest reading in the last 40 years. That's 7.9% year-over-year. Gasoline up 2.4% month over month. Natural gas up 6.7% month over month. Grocery prices up 11.3% year-over-year. Eggs in particular, which I know became somewhat of a meme on Twitter, those were up the largest annual increase in 50 years in eggs in particular. So definitely disinflation present in some parts of the economy, but a lot of the major sectors are seeing that month over month and really a 3-month average rolling increase in prices. So maybe not quite as much disinflation as we would like to see. Let's talk about the market reaction, right? So stocks have been pretty volatile. Were pretty volatile yesterday throughout following the CPI release, but ultimately rebounded, closed at more or less at the highs, but basically flat. So here's how stocks have performed this week. The Nasdaq is really outperforming, and the Dow is sort of lagging a little bit. The dollar looks, poised to continue its rip higher, and yields are also on the move higher to reflect some renewed investor expectations about the federal funds rate, which I know that Mander is salivating to dive into. So why don't you go ahead and cover that for us?
Yeah, I couldn't have said it any better. I think, and I've said this before, I'll say it again, we did come in with that year-over-year decrease for, what was it, the 7th consecutive month here. But the one that kind of caught me off guard was that month-over-month increase. It was the highest month-over-month increase since October, when we got that unexpectedly high print where we gapped down, and then the bulls jumped in really aggressively at the open. So that's what kind of surprised me, especially after getting a negative month-over-month for once, I believe, in the previous print. Now to go back to plus 5% 0.5% month over month is a little alarming. But let's see how the debt markets reacted, and let's do a quick flashback to what we were harping on. They're actually pricing in less than a 4% chance that we end the year over 500 basis points. Right now, there's an 83.3% probability that we end the year with the upper bound of the federal funds rate under 500 basis points. If you remember back to December, they almost unanimously said they saw ending with the lower bound above 500 basis points. Now you have an 83% market pricing in of under. The markets are pricing in that inflation is going to come down sooner than the Fed is saying. They're calling BS on the Fed. When the yield curve drops like that and the floor comes out under it, it eases up pressures on stocks, and stocks rally. And I think that's why we've seen that massive rally in unprofitable tech. The peak of the yield curve is the 6 month at just over 4.8%. So still 20 bips under where the Fed is saying they're going to pin the year on the terminal rate with no pivot. And so I think that's why we've seen this massive rally as you hit. And so now let's look exactly how just 2 weeks ago we brought that exact same chart up. As I said, there was a 3.9% chance that was getting priced in of ending the year above 500 basis points, which was a stark difference from what the Fed was really saying. If we now go ahead and look into what's being priced in after the CPI print yesterday and after the FOMC meeting last Wednesday, we are now sitting at a 67.4% chance ending the year above 500 basis points. And so vast difference here. We really haven't seen a reaction quite yet in stocks. We saw a little bit of a landslide, but to me, the proof was in the pudding here that we had this massive rally going into really the start of this month off of that easing in financial conditions. But now that we're starting to see federal funds rate futures go up, all the treasury yields are up through the roof. The 6 month is now above 5% that we were harping on. It really didn't make sense that it was 20 basis points under that. And so now I think people are finally starting to price in the legitimacy that the Fed could not be lying in this, and they're going to hold rates above 5% for the entirety of the year with no pivot. And so that being said, let's move into how the 10-year is looking versus nominal GDP. This was a great chart I pulled from Markets and Mayhem, because even as we just saw this 20 basis point increase, it really is starting to look like, at least historically, there's significant upside still left in the bond yields moving forward here, because the 10-year almost perfectly tracks nominal GDP. Going back really 70 years here, you can see the top of those bars overlapped with the 10-year yield chart. They're almost an identical comparison, but right now nominal GDP is sitting at 9.3% with inflation so high, And the 10-year, even after this recent rally, is only at 3.77. So that's barely 40% right now of nominal GDP. So even after this recent squeeze we saw in yields, it still kind of looks like there's a little bit of upside left here as we continue to move forward. And what's that going to do to stocks? Let's overlap the S&P valuations with a PE ratio over real rates. Going directly from that, stocks are still seeming kind of overvalued here as we compare them to yield. So I get the markets are forward looking, and I'm not really trying to give this objectively, right? But you can see, even going back to 2017, it's almost a perfect overlap of the 10-year real yield with an S&P 500 PE ratio. And if you look here on the right, the y-axis is inverted. So what this means is as real yields go up, and as the 10-year yield continues to increase, as it continues to break out here post FOMC, post Fed, that line is actually going to go down. And so to get to this equilibrium with the S&P valuations and real rates here, that's not only going to have to decrease as real yields increase, but then as we move forward and companies are making less in earnings as we get into this recessionary climate for the rest of the year, right? If the denominator of your PE goes down, stocks are going to have to decrease, one, for that, and then two, to also catch up to the real rates right now. So that's kind of what I'm looking at from a macro standpoint. I do understand the rally here. I understand bulls are still eager at the bits to jump in here. We haven't really seen a rollover yet reflecting this bond pricing. That's what I'm watching moving forward, is that we haven't seen this reaction in the stock market yet.
Right, man. I hit on a lot of good points there. And one thing that, I guess I should point out before we wrap up is we have seen a lot of this movement, like we said, in currencies, right? In the US dollar, we've seen a lot of this movement in bonds, and stocks really haven't followed. Yes, last week they had their worst week of the year. But I mean, really not off the highs by that much. So we'll see if there's some sort of reconciliation that comes, or if stocks are going to continue to stay strong. We'll pass it back to Alejandro.
Awesome, fellas. Thank you. Let's talk about the system. Let's talk about yesterday's trading. This will be quick because realistically, yesterday was more about trading the levels, understanding the environment, trying to make profits, locking them in when you had them, and moving on with your day. The reason for that, on a CPI day, you can expect a bunch of fake outs. So in theory, we have the system that's going to guide us. It's going to let us know what to do. Let me go to the 30-minute chart so you guys can get a better picture. Look at yesterday's price action. Now, when you're entering a volatile environment and you know that things are going to be moving fast and you know there's going to be fake moves, the moving averages just aren't going to do it. The reason for that is because, of course, they're lagging. They help us to predict future price, but we need momentum in the market. So when momentum is shifting, the system does a really good job of letting us know. But when there's no momentum and things are trading sideways, like a day on CPI, where there's a whole lot of nothing going on. As I mentioned earlier in the show, we closed basically where we opened, but there was a ton of price action intraday, a bunch of range. Something like this isn't going to be your best friend. The moving averages on a higher time frame, at least, aren't going to be your best friend, and you have to know that. So yesterday, my trading was about trading the levels. On CPI days, I think that it's important to watch for fake breakouts, false breakdowns, and you can trade in the opposite direction. Here's one example. We get the false break above, and then you could play it on the way down. The false break below, you play it back on the way up. So you have to have your levels drawn out. I did a video on that on my Twitter that you guys can watch that goes into further detail. But going into today, the 50 SMA is going to be back on my radar. I want to watch if the Bulls are in control or if the Bears are in control. It's going to be very, very important to watch not only the 50 SMA on the 30-minute chart, but also the 50 SMA on the hourly chart. I'm going to put more weight on this because obviously the 50 SMA on the hourly chart we know is stronger. And we're just looking for the market to do something. We are still within that giant bull flag in the S&P futures. Technically, things still look bullish. I'm watching for a breakdown to change that thesis, but we haven't gotten much of anything. So it's been take your profits quick, do your best to trade the chop, and hopefully we get some momentum soon and the system can signal us of that. That's going to do it for me. Time to pass it over to Ramsey Rippers for Bet the Bell. Do it for the system. I'm going to pass it over now to Ramsey Rippers for Bet the Bell. Good morning.
Good morning, guys. Very serious questions.
Good morning, gentlemen. Let's get right into it. Ryan, pull up the green or red stats. I want to see where we're at on this beautiful morning. Perfect morning to ask the question, green or red for the guys. SPY is down, what, a point, 0.25%. Market's relatively flat. The king keeps increasing his lead, although I will say Mander is only one game back in the loss column. Diamond is undefeated in the month of February, 6-0, just shredding it. So well done.
That's actually nuts. That's a ridiculous stat.
Well done. Well done. Champs do champ shit, right? So let's get right into it. Green or red today, guys? Mander.
I'm gonna take red today. I gotta stick with my macro gut here. Play the yield inverse.
All righty. Alejandro.
I'm going green. Green today.
Mo.
Red.
And Diamond.
I'm also going to go red. I think it's, again, a coin flip. Look at the daily chart. So indecisive.
Yeah. It's pretty interesting too. I was looking at the weekly chart. As of right now, I mean, we still do have 3 full trading sessions to go. We are looking like it might be 2 like back-to-back weeks, inside weeks. If you guys take a look at that chart. So interesting to see. I think that, the economic data coming this week, I thought CPI would be the one to push us out of that range. We got retail sales that was that this morning at 8:30.
Retail sales came in this morning, over expected, and then PPI tomorrow.
Okay, so hopefully, we'll get some movement out of this like 405 to 415, 420 range. So next question. I want to talk a little bit about Tesla, and the baseline of this question is bearish or bullish. What do you guys think? So Tesla just announced they're going to open parts of its charging network to all drivers. They announced that, I believe, earlier this morning, or it might have been last week. This move could help reassure road trip loving Americans that they can travel long distance in electric vehicles. One of the necessities of an all electric driving feature is just having a reliable charging network, right? It's hard to, it's not like you're just going to stop at a gas station. You need that time and necessary ports to plug it in, whether it's 20 minutes to an hour, efficiency as well when you're traveling these long distances. That charging network already exists, but it's only available for Tesla drivers until now. So Tesla plans to open at least 3,500 new and existing 250 kilowatt chargers to drivers of all kinds of EVs by the end of next year. What do you guys think about this? But bearish or bullish? I mean, I on my vague, not too enhanced research, I think this is great. So Moneymander, what do you think?
Yeah, I got to say bullish as well. I get the argument some people were saying in the Tesla cult that they don't want them to open them up to other people because if you keep it proprietary, it makes people want to buy Teslas. If they, Tesla has by far the vast majority of electric chargers across the country. So if you keep them Tesla only, people have to buy Teslas. But I think right now, as they're getting hammered on profit margin and everything like that with the price cuts, it's a great way to increase some revenues in the near-term future.
Hondo.
Yeah, so definitely bullish. The important thing here is government funding. So Tesla's going to get $7.5 billion from the government now to build these new EV charging stations, which they haven't been able to do in the past. So they've actually been doing this in Europe. But the reason they haven't done it in the States is because of the connectors that they use, and they've been built specific to Teslas. So now these new charging stations, the connectors will be able to be used on other EVs as well. So lots of money from the government. And obviously, this is just expanding their charging network. I think it's all in all good for Tesla.
Mo. Man, I don't give a fuck if it's good or not. I'm going to tell you what price action is saying. That's a bullish close on Tesla yesterday. So I'm bullish. Fuck the news, man.
This
guy. Diamond.
I'm going to say it's bullish. I agree with Alejandro. I think just the primary part is really just increasing the entire market, right, for EVs. And I think that this helps to facilitate that. As long as they can maintain a lot of market share in that whole space, the larger that the space grows, the more money that they'll make themselves. So bullish.
Right. And I don't really even know how much more Tesla can increase their brand awareness. I feel like most people know who and what Tesla is, but in the sense that, now you might be driving a Kia Soul or I don't know if Kia Soul is EV and any other EV other than Tesla, and you're going to be plugging in, the Tesla type charging port. So once again, just good brand awareness, solid marketing as well on that standpoint. Sal, so next question we're going to go into, I want to talk a little bit about the national debt. Basically, I just want to hear what the key drivers in your guys' opinion are of the increasing national debt. So as of today, the U.S. national debt has increased by more than $8 trillion since a little bit before the pandemic in 2020, late January of 2020, pushing it to the total debt to all-time highs of 31 trillion. I kind of wish the stock market was like the national debt clock, all-time highs every day, every second, actually. So, the economic effects of the pandemic and the legislative response to mitigate these effects have exacerbated the pre-existing imbalance between spending and revenues. Money Mander, what do you think about some of these key drivers to the national debt, especially the mismatch between spending and revenues?
Yeah, that's really exactly what I was going to say. I think national debt going into all-time highs here really just makes sense because as your economy continues to grow, you're going to spend more. Really what the issue has become is the amount they're front-running GDP by, which I want NBA Diamond to cover after I get off here. Really post-pandemic, though, I think everyone saw the government spending and stimulus that really drove us to the point we're at. So I don't necessarily have an opinion on what's going to give. I think eventually they're going to have to raise the debt ceiling. That's the only option I see really plausible because the ramifications of defaulting on their debt is way worse than raising the debt ceiling moving forward.
Diamond.
Yeah, I mean, like what's pushing the national debt? We're spending more than we're taking in through taxes. I mean, I feel like that's just been the model, over the past several years. And you're exactly right. I think that when you have a situation like COVID where you get less tax receipts as less people are spending and working, and then you're also spending more money to sort of have a response to the pandemic. That's a terrible formula, and that's where things sort of get out of hand. But the one thing that I would urge people to look at, instead of just looking at it in a vacuum, like it seems like a lot of money, $31 trillion, obviously none of us can comprehend what that even looks like in a physical aspect. I would recommend that you look at the growth of our national debt and our national debt to GDP relative to that of other countries. I think that the United States is measured against other nations. It's not measured in a vacuum, right? The United States solvency is really sort of a ranking system as opposed to just it being its own absolute thing, right? It's relative to how other countries are performing, how other countries' debt to GDP ratios are going, and things like that, how the global economy is going as opposed to just what's going on here at home. So while I think you can look at the clock every day and watch it tick up to, as Ramsey said, new all-time highs every other second, it doesn't really do you that much good. People were worried about the national debt in the 80s, and 40 years later, we're still here chugging along. So that's not to say that this isn't a problem, but that is to say, don't lose your shirt over it, I guess.
Right, completely agreed. And I just think it's important to note that the debt held by the public as a share of gross domestic product has been slightly more, since 2020. Back in the 2008 financial crisis, I don't think that it was, if I'm correct. So that's another key factor to the unprecedented time. And then I guess just like a statistical projection based from the Congressional Budget Office. They think that federal spending will climb from 23.8% as it is as of 2022 of gross domestic product to over 30% in 2052. And revenues, on the other hand, are only projected to climb from 19.6% of GDP in 2022 to a little bit over 19% in 2052. So who knows, right? It'll be interesting to see how this data comes to fruition as we, progress in time. But that's going to do it for Bet the Bell. Pass it back to Hondo here.
All right. Thank you, Ramsey. We're going to go to Mo for Mamba Market Analysis.
Go ahead here and share my screen. It's massive. They were just infamous trend line right here. All right. Good morning, guys. SPY daily time frame here. So remember the rising wedge we had early on, and it was invalidated with this break and hold up here, but the RR wasn't there, right? The risk reward to the long side wasn't there because we had this nice supply zone up here. And then if we did get above that, you have a nice potential move into this gap fill, right? Never did, rejected, came down, back within the upper trend, but removed that since it was invalidated. I keep my lower trend in there, right? So what happened was we ended up breaking below the lower trend. Not just that, we also had the 408.8 level back here, here, and here, right? And we got a break hook and go to the upside, rejected that zone again. What did you form now? You have somewhat of an expanding bullish pattern here on SPY. Yesterday, we were talking about, I was talking to Mander about this live. We ended up rejecting the lower trend line right here, this yellow one, and then the expanding bullish triangle. We did test both, reject and close below. Not just that, you did slightly close below yesterday's close. Monday's close. So you have more going for the bears, right? Just as we noted here the other day, yes, we stayed below this level, but you came off of a trend line here, and you had a strong close into the level. Therefore, you have more going for the bulls, and that's what we saw yesterday happen, right? Off of this close. Today, though, you do have more going for the bears. The trend line rejections, you're staying within the pattern. This ends up breaking and holding. You're going to aim to retest this, get through that. We're looking for gap fill where potentially we'll get a trend reversal. If not, if this ends up coming back down, you do have this lower trend line. I mean, we could just continue to see some nasty price action here and eventually maybe come here and test this and then bounce. Who knows? Or if we get through this, who knows? But for now, I am bearish on the day due to the trend line test rejections yesterday. The close below Monday's close. And we'll look to come back down and retest this 408.8 level. If we do close below, I do expect continued downward momentum for tomorrow. So if we do close today below 408.8, I do expect to move down to this trend line and test. And then we have this key level here, 400.3, but we'll get there when we do on the daily. All right, candle by candle, day by day. Thanks, Hondo.
Thanks, Mo. Sandman said it best in the comments. The mother of all bull flags. Everybody is watching. We'll see how that one plays out. Now for trade of the week, we got an absolute ripper. Brian, run the clip.
It's time for America's Trade of the Week.
Now, here's a guy who knows how to trade stocks.
Mander, take the floor. Take it away.
I'll take it away. That one hurts here in Collinsworth, man. We're not going to hear him for another like 200 days. Now the season's over. But let's pull up this chart here if we can, Ryan. Really great trade last week as we saw the rollover on Thursday. I took Nvidia short. I was really watching this one as it broke below the open after the gap up. Kind of formed this intraday bull flag or bear flag there, moving up to the peaky. So I took initial ads on the 222.5 puts at the 8 EMA, added some more at the 30 EMA as we came up and tested really the top of that bear flag overlapping with the 30 EMA. Got the perfect rollout. So I didn't get these fully risk-free, but they did go 100% and fill the gap on Thursday. I took half the position overnight into Friday, especially after the price action we saw into the close. I was fully out of these at 450%, but I'm pretty sure they ended up going like 750, 800 at low a day. But really incredible trade there on the rollover of Nvidia last week.
Beautiful trade, dude. Beautiful idea. Even better execution. I think Mo was in the same trade, right?
Dude, I was hoping no one would say that.
As soon as I said beautiful execution, I was like, wait, I know somebody that didn't execute. Quite as well.
Hey, look, I did, but I did not end up swinging them. I don't know why I did not end up swinging them till the next, at least the fourth, right? I ended up closing my whole position that same day instead of holding something into tomorrow. Just unlike me, but I have no idea why I ended up doing that. Hey, sometimes you make those decisions where you look back, you're like, why the fuck did I close that? But it is what it is. It's still ripped though. I think it ran like 76% that same day too. So it was definitely a ripper. Gotta love it when Mander and Mambar are eyeing the same thing, have the same TA.
It's been a common theme recently. When you guys are on the same page, we've gotten some rippers in the Discord.
Yeah,
Pippen and Jordan.
Nice.
Yes, sir.
All right. Now to wrap up the show, we're going to do today's top watches. We're going to go to Mander, who's got a chart to share. I'd pay attention if I were you guys. Clearly, he's trading well.
Yeah, perfect. So I'm watching Apple here, really where it's at. And I think given off of how I feel with the macro perspective of stocks not really making the parity move with yields versus what we're seeing in the actual stock market, there's no denying we're in this really, really strong bull flag right now with pretty decent price action. So I wanted to find a setup that would pan out to either side, regardless of what the markets decide to do. So Apple is really sitting here right at the very, very top of this bull flag that's getting extremely tight. So either we break out above the bull flag, I'm expecting a retest of that double top at 157.50, or we reject the top of this bull flag, fall through year-to-date support there, and then have the gap go down to 145. So I think this one's set up really, really key to both sides.
All right. Awesome chart there, Mander. Thank you. That's going to do it for this morning's show. It is 9:06. Appreciate everybody that tuned in to this morning's episode of Beat the Bell. We'll be trading live all day long in the Kane Capital Discord. You can go to kane-capital.com. We've got a 7-day rolling free trial going on right now. So jump on, trade with us. We'd love to have you. We'll be on voice right at the bell. Other than that, it was a pleasure, as always, doing the show. Everybody trade smart, manage risk, and we will see you back here on Friday morning at 8:30 a.m. Eastern Time. Have a great rest of your day, everybody.